Can everybody hear me? Let me know if the sound is clear. Thank you so much. Thank you for having me when investing. It's great to be back. And today I'm going to talk about what I love, which is gaps and the market. So my name is Melissa Armo, for those of you that don't know me. And if you'd like more information, you can email me at melissa@thestockswoosh.com. Today I'm going to do a very basic webinar for those of you that have no idea what a gap is and no idea how to read a chart. I'm going to talk about technical analysis, and I'm going to talk about candlesticks, and I'm going to talk about charts and the things that I have on my charts. So this will be really a review for those of you that are already trading, or if you're already trading gaps. I still think you'll learn something new, even if you do currently day trade, which would be about the way that I look at gaps and the way that I approach gaps in the market. I only do one thing, which is gaps. And I will tell you that I prefer to short. Now, that doesn't mean that I never go long any gaps in the market. I do sometimes, but it's rare. I prefer to short. And one of the reasons is that selling action that comes into stocks happens very quickly. And I like to be in and out of trades fast. That's just me. It's my personality. I also find myself that I'm less at risk when I trade like that. And then I know that I have got the money on the table and it's booked. It's never over to the fat lady sings kind of philosophy. When you're in the market, you don't know. Although occasionally I will do options where I'm in them overnight. But you can day trade options. And I'm going to talk about a trade actually that I called today and one of my students did. And he just wrote me a nice email. He did it and he doubled his money in one day in an option trade today. So feel free to ask me questions. I see everybody's writings up there in the questions. You can go ahead. But this is really going to be a lecture that's going to introduce you to the market and gaps. And we also are going to talk about the last week's results. So I put in here the gap picks that I had from all last week, Monday, Tuesday, Wednesday, Thursday, Friday, and then this week, which was Monday, Tuesday, Wednesday. And I'll kind of give you an idea of some of the stock symbols that I looked at. I don't have all the chart picks in here, but I got the symbols. So you can go look them up yourself, all the ones that I did, and we're going to talk about that as well. Let me see here. I can see the questions. Let me just make sure I move this over as we're talking. Okay. Okay, great. Will there be breaks between the speakers? Oh, no, that was really this morning. Somehow I just went back to the beginning of time. Okay. It just took me back to 9 a.m. That was funny. All right, here we go. These were the results for the last week and a half, okay, because today is only Wednesday. So I did a full week, which was last week, and then I did the ones for this week, too. So these were all shorts. I will tell you that. Now, somebody's asking, is the system based solely upon daily charts? The answer is yes. But you can look at other charts and see gaps on any time frame. You can look at a 1-minute chart or a 15-minute chart and see the gap. But I have a method that I created, which I'll talk about at the end, which is what I teach in my class. It's a rating system and how I determine the picks. And these were all the picks. In other words, last Monday was QCon. How did I determine QCon was a good short from the daily chart? That's how I determined it with my rating system. But you can see gaps and look at gaps on any time frame. Okay. Can you use an Ameritrade platform? I've never traded with Ameritrade. My answer probably to that would be yes, because if you can see pre-market and post-market data in stocks, which I'm sure you can with Ameritrade because they're a huge, huge, huge broker-dealer, then, but you got to call them to find out. As long as you can get post and pre-market data to see the gap and a daily chart and a 1-minute chart, I'm sure you can use them. But I'd call and double-check with them. Do I scan to find stocks that meet criteria? Yes, I scan, but I manually scan using my eyes and my brain, not with a scanner. You can actually buy scanners, and if you take my class, you can program the points into a scanner, but that's not what I do. I use my own brain and my own mind. And actually, we're going to look at a gap that was a pick today that I looked at in the room. It was PBI, this one down here. Let me just see here. Does he use a charting program? There is no special charting program or software. You can use any charting program to trade my system. I don't sell any charting programs. I just have my class, which I teach you what to do. Can you automate the system for placing trades directly with your brokerage? That's what I'm saying. If you want to do that, you have to set it up yourself. I don't do that. I don't have any special software that I sell or market myself. You can really trade any place that you want to, as long as you can short the stock Or if you're doing an option trade, if you're going to short it, you buy the put or buy a call, and you have to be able to see the gap. That's what I was saying. And gaps happen in the pre and post market, and we're going to look at some charts. So good questions here to start out. Oops, wait a minute, let me go back. So Monday was QCOM. Tuesday was Verizon. This was a short, it was a winner. Verizon was a short, it was a winner. Last Wednesday, TXT, short, it was a winner, okay? Thursday, Matt, short, it was a winner, okay? Friday was Juniper, short, it was a loser. This lost. Then CL was a short. Oop, I spelled that wrong. This was a winner. Monday, TPX, short, winner. Tuesday, UA was short, it was a loser, okay? Wednesday was PBI, short, which was today, it was a winner. Okay, so of these ones here, of those 9 trading days, okay, or 9 stock symbols, I'm sorry, because there was 2 on Friday, 8 trading days and 9 stock symbols, there was a 77% win ratio using my system. So the bottom line is that the rating system I use to determine whether the stock is a long or a short, it works. This is the reason that I'm successful trading for 8 years, and it's the reason that I have a successful business, and it's the reason my students are successful. Just because you find a stock that's gapping, which we're going to go over gaps, because I'm going to go through charts, and we're going to do this, but I wanted to show you here in a minute. Just because you see something in the market that's gapping, you have to have a determination which way to trade it, long or short. And it actually doesn't matter what you're doing. If you're looking at any chart as a day trade, or anything that you want to buy or sell, whatever you want to do, this is if you're trading stocks in the U.S. market, even if it's a different strategy other than gaps, for example, the only way you really make money is if you're able to predict the correct directional bias for the move, okay? If you can't accurately predict where it's going to go in the right direction, then you're not going to make money in it. In other words, for example, if you would have gone long PBI today, here, let me see if I can bring up that live. I don't know if, here, let's see if this works. Tell me if you can see, I'm going to see if I can bring up, can you see that chart? Does that come up? I just flipped on, I don't know if I have to click on and off. Can you see PBI? Can you see this live right now, or do you still see the PowerPoint? I don't know if that worked or not. Can you see it? Wait, there's a lot of questions there. All right, having a ton of questions here. You can see it, okay. All right, well, this is good. I'll flip back to the PowerPoint. Do you see, if you would have gone long this was today, this was a gap today. If you would have gone long this, you wouldn't have made any money at all. So the only way that you would have made money doing this today is to go short, because the stock dropped. High of the day was 1508, low of the day was 1241. This went to an insane number. It never looked back. So getting back to this here, what I'm saying is that the only way that you can make money doing anything at all, whether it's gaps or something else, is if you're in the direction right. Otherwise, 9 times out of 10, you will lose, okay? So here is today's gap. It was a bullish gap. It was Apple. Now, I made an option call in this today for the people in the room in the letter, and Apple had earnings. It had earnings last night, and it gapped up. Okay, now I'm going to show you this here. This is a daily chart. Someone asked about the daily. So the stock closed last night. What is a gap? A gap is when the closing price of the stock is at one price point, and then it opens the next day. So this is 4 o'clock last night on the Tuesday. Today is Wednesday, and it opens up, and it gapped up. So it opened here at approximately 127-ish, something like that was the low. So the stock gapped up. This is Apple. So you could have day traded this today and gone long, or you could have done an option in this. So before the open, I saw the gap in Apple and sent out to the people in the option letter, buy Apple calls right into the open. Get them, take them, do it right away, whatever, get in, okay? So I had people ready to go to get this before the open to put the order in to do it. So you could have day traded this, or you could still be in it. Why? Because this was the call. It was to buy Apple 130 calls expiring February 10th. Boom. Guess what? Last time I looked, it was 40-some cents away from 130, and it's got a week and a half left.
So I just got this email. I just got this email like an hour ago from one of my students. He said, thanks for the great Apple option trade today. Didn't see the email until a little late, but got 40 contracts at 44 cents. Low in the day in the option chain was 25 cents, by the way. He sold half at 88 cents and then went to lunch and came back and saw him at $1. It went over a little bit over 102 was the high in the option chain on this one today. The 130 calls. He said he sold out so the room and option letter almost covered this trade alone. He's in my trading room as a day trader, and he also has the option letter. He said, thank you, and you're just getting started. This was very nice. Anyways, I want to show you here how this client then made money today. He bought 40 contracts of 4,000 shares. The cost was not cheap. He must have really believed in my call. So he was basically 40 contracts cost him $1,760. He doubled his money. He sold it at 88 cents, which makes 100% sense because he doubled his money on the day, although he still could be in it because it's going to go over 130 between now and the time they expire, which is February 10. But you have time value in here. So he doubled his money in one day. How did he do this? How did I make the call? It's based on the gap rating. It's based on the gap itself, which we're going to talk about, and that's the rest of the class today. But I wanted to show you an example, a real live example of a person that just happened today that's in my room and in the letter that's done the class that just made money. So you can do this. There's one underlying thing that you have to understand about trading, and I get that there's a lot of different ways to trade, and there's a lot of good people that are talking all day today, and whatever you decide to do, whatever way or method you decide to trade, it's up to you. You have to do something that makes sense to you, that resonates with you. But I will tell you this. You can make money in the stock market. You can. You can. I know that a lot of people know that I'm doing it, but I really have real live people that are regular people like this man here that is, and many, many others that are doing it. So this is not beyond the realm of possibility. It does not have to take you 100,000 years. It doesn't have to cost millions of dollars. You don't have to wait forever. You don't have to suffer and blow up accounts 100 times over. It does not have to take that long, but you do have to find a system that works, and you do have to listen to your mentor, whoever that is. And there's a lot of people here today that are teaching different things. My thing is gaps, but whatever you decide to do, you got to listen to the person. Obviously, my people believe in me because the guy was $1,700 today, and if the trade had gone flat, he would have lost. And that wasn't a nothing amount of money to risk in a trade. 40 contracts in Apple is actually a big size. Okay, that's 4,000 shares basically. All right, now let's get into it. How did I do this? The points. That's how I made the call, and I did it in the pre-market, and somebody said, what do you need? All you need is a chart, a daily chart that you can see the pre-market data of Apple. Or you could have seen it last night, but you can't take into a trade at the night time. You can't do options because they close at 4 o'clock. They're only open from 9:30 to 4. Although you can trade the pre and post market as normal trades, but I don't do that. I think it's too wild. No, I did not short the gap. No. Why would you think I would have shorted the gap on Apple? Cliff is asking this. No. In fact, here, hold on. Let's bring up Apple before I get into the teaching part here. Let's switch it out. Can you see the chart again? No. Where would you have gotten that I would have shorted this? That's what I was saying at the beginning of the class here today. I do go long and short, but I prefer to short. But I'm showing you here that a long worked here today too. But it was an option trade. But you could have day traded it too. But no. I would never have shorted this because it is a long. It is a bullish gap that per my system would have met the criteria. I would have never called the option trade. In fact, I was so confident in it, I didn't even wait till the stock opened. I made the call to the people before 9:30. You couldn't have taken the trade after 9:30, but I wanted the people to get it because I wanted people to take it and get the order out into the open, which is what that guy missed it right away. But I'm sure somebody in the room in the letter got it. I'll get other emails, I'm sure, about the people that did it. But the point is, no, it was a long. It was a long. Okay? Look at this. This is what I'm saying. If you had shorted this today, you would have lost. And you know what? Some people did. I'm certain that some people did. I'm certain that some people shorted the stock today and lost. Now, where would they have shorted it? Some day traders probably thought this was going to fill the gap, and they probably did. They probably shorted it. Oh, wait, let me go. Today's date is, hold on, it's before. This is a 1-minute chart, and then I'll get back to the class here because I have a lot to talk about today. I only have an hour. This thing here is what many, many people don't understand about gaps. People probably tried to short this in here. Day traders probably shorted this in here after booped over the high, probably shorted in here, never even broke the low. They shorted probably here again because it did a lower high. It did a lower high here, and I know how day traders think, but guess what? I don't trade based on what day traders are doing to other people. I trade based on what institutions are doing that created the gap, and guess what? They're buying the stock. Institutions in the market are the ones that I trade with on the side of that, and I'm very good at reading it. The same thing with PBI. PBI got sold off today and dumped like a, I just made up a new word today. It's called a super swoosh because that stock dropped all day. It's going to zero. This thing today got bought by institutions. So day traders, I'm sure, did try to short this stock today because it made a lower high in here. And they might have shorted again in here. But nobody made any money shorting this today because it was a long. And why was it a long? Because institutions bought this stock, and they're the ones that are controlling the stock, and you got to be with those people. It's the big money in the market, and that's the only way you make money trading. And that's what my method and system predicts. It predicts what the institutions are going to do on the live day. On the live day, you see what they're doing in the gap. And then I see the gap. I don't predict the gap itself. I wait till it gaps. I didn't know if the stock would gap up or down. I kind of had a feeling. But the bottom line is that this gapped up. You wait. Then it does the gap. Then you rate it. Then you look at it. And the rating system determines if the institutions are going to carry it through and keep buying it, which they did here, or sell it into the gap. But no. There are day traders, I'm sure, that shorted today and lost. And I'm sure there are people that are probably going to try to short this another time soon, but it's not a short. And let's go back to the class. Okay, now let's talk about online trading, why you can do it yourself today, the change in information flow and trading for a career, okay? Now, why can you do this? You can do this because the spread nowadays, trading, is usually very tight. Sometimes there are spreads in stocks, the difference between the ask and the bid, that are wide. I typically kind of try to shy away from wide spreads. I don't like doing something that's more than 30 cents. I really have to feel like 100% conviction if I even take anything that's over a 10-cent spread. Usually I try to trade things that are tight, 1 to 2 pennies, okay? Commissions nowadays when you day trade are cheap. You can find places you can pay $5 or $4 or $2. If you're paying $90.99 an in and an out, that's $20 a trade, you're paying too much. You got to get that rate down. And there's tons and tons of places, and you can trade really cheap nowadays, okay? Everybody out there that's a broker-dealer, they're fighting for commissions. They want clients. Shop around, okay? Again, I'm not a broker-dealer, but I'm telling you, do your due diligence when you choose places to trade and don't get ripped off. Now, what else is good? We have instantaneous information now. I have Verizon Fios. If it goes down, I have Wi-Fi. I can go across the block to Starbucks. I mean, and anywhere you go now, I could be in a cab and I have Wi-Fi. I don't have my platform on my phone, but I mean, we live in a world where you could be anywhere at all, and have data instantaneously about what the stock price is doing if you're in a position. So we live in an amazing world and a great time where it's a 24-hour news cycle now. My goodness, if I go to bed at 11 o'clock and I get up the next morning at 5 a.m., 100 things have happened in the world. I get on my Twitter, I'm like, I can't even get caught up by the time I go to the gym. We live in a world that is active and moving, and we're all tied together now. Things that happen in different countries affect the U.S. market, and it's a 24-hour market. Again, I don't trade Forex, but things that happen in other countries affect the U.S. market, and vice versa. And so it's round and round, 24 hours, okay? We're all tied together, people. So it's a very interesting time that we're living in to trade, and it is a good time to make money. I mean, ever since the election in the United States, the market has done nothing but rally. Nothing but rally, okay? So let's talk about orders. Again, instant execution. If you're taking the trade, if you're getting in and getting out, 9 times out of 10, you're getting filled almost immediately. And again, I trade stocks with lots of volume. You saw the ticker symbols of the ones I looked at from the last couple of days. I don't trade penny stocks. I don't do stuff that's too thin. I want to be a blip in a stock in the position I take, and if I take a couple thousand shares, then I don't want anyone to notice me. So I think it's very important to trade in stocks with volume. Let me just see. What told you that the gap would not fill to go long? That's a question from HE. Because I have a rating system, which is what I do and what I teach in my class and what my trading room, what we all go by, that told me in the pre-market when I looked at the gap and I rated it on a chart. I have 26 points I used to rate the gap that it was going to get bought. It was going to follow through higher. It rated high. I have a 26-point rating system. If the stock rates 20 points or more in the direction of the gap, it's going to continue in the direction of the gap. So in the case of Apple, it gapped up. It rated more than 20 points. That meant that it was going to go long. In the case of PBI today, it rated over 20 points as a short in the direction of the gap, which was a bearish gap, which we'll go over more later, and therefore it told me it was going to sell off. In fact, I knew PBI would work so well today that I didn't even rate anything else. I didn't even rate anything else today in the room, and everyone said, well, look at this thing, Melissa, look at this one, look at this one, look at this one. I said, we're not doing anything else. This is the only one today. I had no idea it would go to some crazy, crazy number that would have a 12 in front of it when it opened at 15, but it did, okay? And that just goes to show you, again, consistent follow through and selling. Now, I will pull up that chart in a minute here. But that idea also of gap fills is totally erroneous and does not work as something consistently to do to trade. I will tell you that right now, but I don't want to get too off target with that one. Anyways, you can do this from home and you can be anywhere, and you don't have to live in the United States of America to trade. You can learn and you can do it, and you can do it from anywhere, okay? And it doesn't matter your background, and you don't even have to know anything other than doing this before you come to me. In fact, sometimes I think it's better when people come to me and they never traded before because they don't have any negativity. They have no negative attitude about the market. They 100% believe they can make money. They are very positive, like this guy here. They're starting out fresh. They listen to everything I say, and they tend to do well. So I'm just saying, you know, don't be shy away from trading if you have no experience, or even if you have no experience day trading or doing gaps. You might do better than people that have experience, because sometimes people come to me and they have to delete or flush down the toilet things that they learned that don't work, and gap fills is one of them. So let's talk about, again, a long time ago, people got paid a lot of money to get information, and today there's so much information, it's really leveled the playing field and kind of neutralized the effect. In fact, you can even sit in on those earnings calls. Like last night, you could have listened to Apple's call. You can actually go and listen to all this stuff if you want. So the only thing that's really worth anything that you pay for is you know, insider information, which guess what, is illegal. So nobody does that, and you're not supposed to do it, and it's usually very hard to get it anyways, and you don't want to go to jail. So you just want to look at the price and find a method and a way to do it that you can predict where it's going to go and get in and get out. You can get in and get out at an option. You can get in and out as an equity trade. You could do it as a swing trade, a long-term investment, which, by the way, probably a lot of people are in Apple as a long-term investment, constantly making new products, and people like the company. But everyone has access to everything. It's really only a matter of interpretation. It's true. It's just like Apple. If you lined up 100 people that were traders, and you took a poll of those 100 peoples, how many would say, short that stock today, it's going to drop, it's going to fill the gap, it's gapped up big and it's going to drop? And then you would have somebody like me, and I'm sure I wouldn't be the only person on the planet, or of the 100 people that would have said to buy it, but the fact is, if you have a way to predict what the stock's going to do in the right direction, you can make money. In fact, it would be very hard for you to lose. You'd have to be a crazy person to lose money in Apple today if you went long. In fact, I can't even think of any way that you could have done it. And the other one, too, in PBI, there's no way you could have lost money. You could have shorted that in the wind today and made money. So you have to, it's so important to get the direction right. It's shorting and going long. It's one or the other. Now, if you want to be in the market or you want to do something with your money, what can you do? You can invest in CDs and savings accounts. Every once in a while, I walk by these big signs on these banks in New York, and the way they advertise these rates in the CDs, I think, oh my Atlanta. I mean, I forget what was the last rate I saw for a 5-year CD? It was so ridiculously low that I thought, who would put their money and tie their money up for 5 years and something like that? It was so crazy. It was so crazy. And years ago, I used to be in banking. That's what my original basis was for getting involved. You know, even in the market, I did mortgages, and I was in banking. I was a branch manager at a bank, and my goodness, years and years and years ago, the rates were actually, it made sense to have a certificate of deposit. I had a few when I was young, and even savings accounts made sense. But nowadays, you say to yourself, what can I do something better with my money than this? And guess what? You can by investing in day trading in the market. You have to know what to do. Okay. And of course, people are in mutual funds. Some people have retirement plans. Some people have the 401k matches. If you have a job and you have a company that will match your 401k and you can afford to contribute 100% and they'll match it up to a certain point, then you could do it. You could do it. That's good. Not every company does it anymore. There are some companies out there that are really good companies that will give you really good matches. If you can afford to do it and save for your retirement, okay? And many of these mutual funds are invested in good quality picks. And again, like I said, the market's higher. And some of these stocks have really flown. Amazon, Google, Facebook, Netflix, Microsoft, the overall market, the banks. I can go on and on. So if you've got money in the right things and you can ride it out, all right, you can do well. You can invest money in real estate as well, but that's not a quick turnover flip. Lots of times it depends on whether you're buying at the height of the market or the low of the market or the right timing. A lot of it has to do with timing of real estate, and then you got to be able to hold on to it or fix it up and flip it, and that's just not a quick turnaround for your money. It's just not anymore. And then you have to wait if you want to sell it if you don't sell it to somebody for cash, that the person get approved for the mortgage, and then that's a whole process. All right. So really, investing and trading is a good way to make money if you know what to do. So here's some just quick tips and facts about the market. The New York Stock Exchange was founded in 1827. Whoosh, that's a long time ago. Can you believe that? The largest based on capitalization, over 4,000 listings. The Dow is typically down for the short. I don't really look at the Dow that much. I must tell you, I typically do not look at the Dow, but I know a lot of people like it, and they do, and we hit up over a big, big number. Oh, it was last week? Yeah, I think it was last week or the week before in the Dow. The NASDAQ composite has about 5,000 stocks. The Standard & Poor's 500, or the S&P, includes the banks, okay? And then you have the Russell 2000. So, I tend to focus on, there's two market ETFs that I focus on, right in the room. It's the SPY, which includes the banks, and the QQQs. Oops, did that go? And the QQQs. All right, those are the two that I look at their ETFs. So typically, these are the exchanges. There used to be a big difference, but not so much anymore. All right? You can look at these and go online and research if you want to find out more, but you have to have access to the stocks on these exchanges if you want to go long or short the stocks that I'm trading. Now, there are stocks that have different sectors, and I look at different sectors. If I have a certain stock, like the stocks that were in the Apple sector today, they probably rally with Apple, okay? So you have semiconductor stocks, oil stocks, precious metal stocks, utility stocks, retail stocks, and these are just some examples. So typically if you have something that is gapping and moving in one direction in the sector, it could be for earnings or news. You may have the other ones in the sector going in the same direction, and you can play them all. Now, again, I like to trade stocks or companies, and one of the reasons is because people tend to have emotional investments in companies. Like I said, people love Apple or whatever, okay, or they may love Netflix. So I tend to want to focus on companies themselves, but there are things called ETFs. Now, what is an ETF? It's an exchange-traded fund, a security that tracks an index, a commodity, or a basket of assets like an index fund, but trades like a stock or an exchange. That's what the QQQs and the spiders is. ADRs is something that I really don't trade. I tend to not want to do these, but I will look at them. And pink sheets, again, I don't do it all either. But these are some other things that you can trade. Now let's talk more about shorting, because I said this is what I mainly like to do. If you've never shorted before, what does it mean? It means that you're really predicting that the stock price will fall. And you were getting in it at a certain price. For example, you might short the stock at $15, and if the stock drops to $14, you would make what? $1 by betting or taking the trade, for example, or predicting that the stock price will drop. So you can make money in other ways, not going long. So you're playing the security to decline in price. And you make money as prices fall, and then if it rallies, you're going to lose. And that's why, like I was saying, you had to have been short PBI today to make money. So you're making money predicting the price will drop and then shorting it before the price drops. All right? And this is how you do it. So you have to have a trading account that allows you to short wherever you go, wherever you have your platform, wherever you have your money. You have to be able to short. A lot of day traders do short, but not a lot of day traders know how to short correctly or where to short. Sometimes I short into people, it seems like I'm shorting into the no man's land or the wind, but actually I have a reason for doing it and a setup, and it very often works for me, okay? Now let's talk a little bit about technical analysis compared to fundamental analysis. Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity, such as past prices and volume. I don't focus that much on volume, but like I said, I won't trade stocks with no volume or low volume. Technical analysis do not attempt to measure securities' intrinsic value, but instead use charts and other tools to identify patterns that can suggest future activity. And this is really what I do, okay? This is what I do. I am predicting what the next move of something, for example, like Apple will be by looking at the past price data on the chart. That's how I made the prediction the stock, when it gapped up, would follow through today, and the various numbers that the stock will rally and go to. In my opinion, technical analysis works, and you don't need anything else to trade, and you can make money doing this and only this. Now, the people that do like to use fundamentals and read stuff, you can do that if it helps your conviction level to take the trade, but you don't need to. You don't need to at all. One issue is that very few people are trained properly in how to use technical analysis. Very, very few people know what to do because they're looking at something like the lower highs and lower lows in Apple. Let me quick go back to this one here. Look, this is going to hit 130 today. Oh my Lanta. Oh my Lanta. Look at this. Look at that. All right, let me go back to what I was saying. Let's look at that. It's fantastic. Anyways, many people, okay, are seeing this, that look at technical analysis, and they're seeing this and they're thinking that this is a resistance area, that it's making a lower high from the previous high over here, which was 128 this morning, and then it makes a pivot here, and then people are looking to short it because it made a lower high, and they're thinking it's not going to continue higher, but that's not true. As you can see, it did. So many people don't know what to focus on technical analysis things. They use indicators that don't give enough information to help them make money, or they focus on the wrong things. I'm not saying pivots and things like this can't help you, but it's not the reason to take the trade or not. What is the gap? The gap itself is what is directing you how to play it, and this is what you're following, not this thing here. Because you can't short every lower high and lower low, and you can't go long every higher high and higher low. And many people just want to play support or resistance, but it doesn't always work, and that's how people use technical analysis, and then they wonder why they don't make money. Because you have to have a strategy intact to play it, and for me it is gaps, okay? So technical analysis history dates back to hundreds of years ago. It can be said the principles of technical analysis are derived from the observation of financial markets over a very long time, and the oldest well-known technical analysis method was developed in the early 18th century, which used candlesticks, which we'll talk about in a minute. And I do use the candlesticks to determine the points, all right? This is very, very important because candlesticks depict price. Now, if you're a person that likes this kind of thing like fundamentals, fine. Use it. Use it in conjunction with the technical analysis, but you've got to use technical analysis because you cannot ignore the price, because that's really what is telling you what it's worth. If you want to sell Apple today at $129.85, it hit that price and you can sell it. You can talk and talk and talk and talk and talk about whatever the fundamentals said that said it was worth this or that, but you only know what the price is trading at right now that you could sell the stock. You could say, well, I'm telling you, this is going to go to here and it's going to go to 135, but you can't sell it for 135 today. Nobody's going to buy it at 135 today. It's not trading at 135. It's trading at whatever, 129 something, all right? You have to hold it if you think it's going to 135. And when will it go there? You don't know. This method of evaluating stocks attempts to measure the value of a particular stock. The fundamental approach examines the balance sheet, income statement, P/E ratio. Some people love these things. Again, I don't use this. Management, again, people love to look at that in a company like Apple. Book value, industry conditions, and overall health of the economy, which right now actually is acting like it's very, very strong in the U.S. Okay, that is how it is acting. Whether we're in a heap load of debt or not, nobody seems to care as far as the market goes. There's an overall optimism that is real, it's happening, and you're seeing it play out in the market. So, fundamental issues
of fundamentals is, compared to the technicals, is where do you enter and exit something? If you say, well, the fundamentals tell me this is going up. Okay, fine, it's going up, and then where do you get in? This is what I'm saying, where are you getting in and where are you getting out? Using fundamentals means that despite the fact that, for example, 50 million shares just traded at 14.25, I'm just throwing a number out there, that you feel the stock is worth more based on the classified document you read on the internet, or you were in the call, on the earnings call, or whatever. And this is a little interesting tip here, too. I'm sure some of you remember this. Guess who had one of the best balance sheets ever? Enron. And a lot of these things have to do with it. Look at this, has to do with the accounting practices, okay? And this is like way too complicated to get into right now, but it's something I just want to point out. And it's not something that I use to make my picks, because you don't need to use it. Differences in acceptable accounting methods can produce huge differences in the bottom line, and they do. And it is not that fundamentals are not relevant. It's that they are already built into the price, because what you're looking at right now is the thing that matters. Okay? Let me just see here. Did I do... Just want to make sure I didn't miss any questions. Was the last question at 2:01? Just want to make sure. So let's talk here at news. Somebody say hi or something so I know I didn't screw something up when I wrote in the room. I don't think I did, but somebody say hi so I know. News will usually cause a knee-jerk reaction, okay? Short-term or immediate reaction. But whether or not that news follows through is reversed depends. Is the news really good or bad? You don't know. It's not easy always to determine. And then, of course, something could have news, and you could seem like a good if the stock gaps up, but then it could collapse. It could collapse into the gap. So very often news reactions also can't be predicted ahead of time. Okay, there we go. I got a hi from Philip. So economic data often creates stocks and gaps, very often, okay, and news. And it may or may not be significant in the long-term outlook, but remember what we're doing, we're day trading. Okay, we're day trading. Now let's talk about some indicators here and some things that I use like candlesticks and charts. So this is a daily chart. It's a daily chart here, and you can see, I just want to show you. You have the moving price over here, okay? Volumes down at the bottom. I like a white background. You could do anything you want, but I prefer the white. This is a 200 period moving average. This is a 50 period moving average. This is a 20 period moving average, and this black line here is an 8. Again, you can make them whatever colors, but these are the colors I like. And then these are candlesticks. They're Japanese candlesticks. There are many, many books on candlesticks out there. You can read them and read them for the rest of your life. Tons and tons of books. And there's fancy names for them. I don't use any fancy names for candlesticks, but I do watch what they're doing. I do see what they're doing. I look at them, and the green is depicting buying in them, and the red is depicting selling action. Okay? So here, for example, this is a bullish bar. This is a bearish bar, okay? So the green depicts buying. The red depicts selling. In a bullish bar that is rallying on the day, the bottom of the bar, okay, is the low. The top is the high. In an ideal world, a full-body green bar that would be very, very strong, and this is probably how Apple's going to close today. Apple looks very much like this right now, although we don't close till 4 o'clock, but the low looks like this, and it's not going to break it. It's not going to break it at all. So Apple will close today with it looking like this, and we'll see how the top looks. It might look like that when it closes. So this is a very, very strong bar. This is a very weak bar. PBI, I don't know how it's going to close, but it might close like this, where the high of the open and the stock selling and dropping all day, and it closes at the low of the bottom of the body. This depicts selling action, and it's weak. Okay? And then you have reversal bars down here. And this is called a doji in some circles. It's a neutral bar that doesn't have a color at all. The stock closes and opens at the same price. So you can study these things on your own or look up books, and there's tons of free stuff online. But this is what I use on my charts. And again, technical analysis is looking at a chart and reading the candlestick formations as they move, okay? So moving averages are there for a purpose, but I don't live and die by taking trades by them. There are tons and tons of technical indicators you can put on things. Your platform itself actually pre-programs them. You click in and put them and make them yourself, and you can put whatever ones on that you want. I showed you the ones I use, but I encourage people to not use too many. If you use too many,
it will take away from your ability to be able to actually focus on what the stock is doing and moving and the price, and that is very important. It's more important than having all these different indicators. If there was one indicator that told you everything that you needed to know in the world, then we'd all have it. We'd all make millions of dollars, and it also wouldn't work because it'd be impossible for us to make millions of dollars. Because it's a zero-sum game when you're trading, okay? If we all did something that worked, you can't have a million winners and no losers. That's not how the market is. So there is no one indicator or two indicators that work all the time, okay? So you want to find some that help you make it easier to look at something in a certain direction. I do use a 1-minute chart, a 2-minute chart, a 5-minute chart, a 15-minute chart, and I use the daily. I determine the gap from the daily, and I take trades in the 1-minute chart, which we're going to look at here. But those indicators that I talked about are the same ones that I use in all my charts. Now let's talk about gaps. What is a gap? A gap refers, like I said, where the opening price is different from the closing price. Stocks trade in pre-market and post-market. So after 4 o'clock, you have post-market trades going off. But it's not the live day. But that's where the gap is being created. Or the gap could happen in the morning, all right, when the market opens in the morning. And something could happen like an earnings report or a news report or a CEO getting fired or a sector gap like we talked about. Now, I said this before, I don't really like to trade ADRs. And the reason is because these stocks have their primary market overseas, and they may be trading several hours before the U.S. market opens and the price is adjusted. So it almost looks like ADR's gap every day, but they're not really real, quote-unquote, real gaps. You can't really look at them and rate them the same as normal stocks. So I typically do not trade ADRs, okay? Now let's talk about, again, what is a gap and what causes a gap. A gap is the difference between yesterday's closing price and today's opening price. It's based on the 4 o'clock close, which is real, and probably we will always have a close in the U.S. market, and the 9:30 open. And I'm only trading between 9:30 and 4. I usually trade in a minimum amount of my trades in the first 30 minutes or hour of the day. That's what I like to do. Unless I'm in an option, I may trade it longer overnight. But what gaps do is they create a void where there seems like there's no trades that go off on the daily chart when you look at it. Do you see here where the stock closed here, and then it gapped down? Yes, times are Eastern time zone. Eastern time zone, think New York Wall Street. Okay? So, close here, open here. Boom, here's the void. Now, you have to be able to predict with this void, is the void going to continue? Is it going to sell off? Or is it going to fill this gap, which someone mentioned earlier, is it going to rally? In this case here, it was a short. Okay, and my method predicts that it was a short ahead of time before you see the drop. Now, anyways, the point is, this is a space that happens between the close and the open, and that is what a gap is. Here was today's, again, I already showed you this. This was earlier. This was insane today. Anyways, the stock closed here and gapped down. So it closed last night at 1587 or something. It opened this morning around 15 bucks. So the stock gapped down, and here's the void. Boom. Okay? So what is a stock? It's an event. Apple gapping up was an event. I'm playing a strategy that's an event. I'm playing the event. The event is the gap. What creates the event? What creates the gap? A lot of things. Anything at all. An election can create a gap. But I am determining how I'm going to trade it long or short based on my rating system, which is a checklist, which is 26 points. But the strategy is the gap. Not doing higher highs or higher lows or buying support or shorting resistance. It is based on the gap itself, or not even doing anything with indicators. Okay, this means that an event that happens, and it happens at night or in the morning before the open. Okay, but it happens between 4:01 and 9:29 the next day. Buying and selling pressure builds up into the open, and then something happens. What? You get selling action, or you get buyers coming in, or you get shorting action. Okay, these are all the possible things. So what could the event be? It may be news about the economy. It may be news about a sector. It may be news about a single stock, like an earnings report, like happened with Apple, like I just said. Many, many reasons. But the big reason why you can make money trading gaps, and the number one reason why you see moves like Apple and PBI today, is massive buying or selling, okay? It's institutional money that is trading tons and tons and tons and tons of volume in the stock. And if you are with that in the right direction, you'll make money by doing nothing, just taking the trade and getting out. And whether you get out at 9:35 or 9:45 or 10:02, if you're in the right direction, whether you hold it to the target or not, it doesn't matter. You're up. The way that you make money as a trader, and that's why I showed you the statistics for the last 8 days and the last 9 picks, is that you've got to get the pick right more. You have to win more times than you lose. You have to have more winning times, more winning days. You have to have more winning days than losing days. Okay? If you take a huge, massive trade, like let's just say, and there's no way you would have done this on the planet, but let's just say you shorted PBI. Let's just look where it's at now. It's probably ridiculous now, but let's look at it. Let's just say there's no way you would have held this to this number because I didn't even give the number because you wouldn't have even known that we'd go to the number. But let's just say you shorted this here at the entry today that I called in the room, which was, it was sick, actually. It was $14.89. It was $14.89. It was 20 cents off the high. It's hilarious. Anyways, the stock dropped $2.50 from that call. There's no way you would have held it. No one in the room, I'm sure, did. There's no way you would have known it would go to that number. Let's just say you did. Let's just say you did. Let's say you did and you got this huge, massive, huge trade. You made $1 million today. If you lose for the next 9 days, you're going to give it all back. You have to get more winning days than losing days. That's it. You can have amazing trading days. We've all had them. You can have huge wins, bigger than expected. No one would have held this at 1240, though, I'm telling you. The point is, though, you still have to have more days that you get the pick right, in the direction right, or you won't make it. You won't make money. You won't make money in the short term. You won't make money in the long term. You won't make money for the month or for the week or for the year. And that's what you want to do. I mean, that's why you're doing this. That's why I do it too, okay? So it's a rare edge to find something that has a high probability of consistency and also the movement and the volume, okay, which comes in with the institutional money. Now let's look at this one here. This was TXT. This gapped down, closed here the night before, gapped down, dropped. It's a short. You short it. It flipped, it bounced later in the afternoon. But here was the short, and we did it. Now, what did you do? You would have done this, and if you just would have done it in the morning, although it did go farther, you would have shorted this here, boom, you could have gotten $1 out of it. Now, what does that mean for someone like you? It means, and I'm just trying to break this down so you can understand it. If you have 500 shares and it's short and the stock drops $1, what's your profit? 500 bucks. If you have 5,000 shares and the stock drops $1, what's your profit? $5,000. Okay? So if you have a move in something, you can make money in it, getting the push, which I try to do right into the beginning of the part of the day. Which, in here, let's go back. I try to get in and I just right into the part, right into the morning. You get the push down, okay? So what I do every day is predict where the movement's going to go right away, okay? And they dumped it, and they dumped it, okay? They dumped it into the open. And you could have gotten it, all right? But this is how you make money. So it has to do with the share quantity and the move and the right direction. So you think about it, it's, you know, you're adding to the selling pressure when you're shorting the stock. But what really makes good moves in shorts is selling. You would never have a move like PBI today if you didn't have selling. It's selling action. And this stock, let me just pull it up really quickly. On the 1 minute chart here, look at that. Look at that. That is, in fact, let's just look. From 9:30, that's insane. For 19 minutes straight, the stock sold off. Look at that. That's selling. So you are predicting the selling action and you're shorting it, and that's how you make money. You make money shorting, predicting selling action. That's not to say there aren't shorts in there, but that's how you really make a lot of money going short. And how do you make a lot of money going long? Well, you predict the buying too, like an Apple. So that's what gives me an edge, is I'm predicting the gap where the stock's going to go in the live day, and that's what I do. And the bottom line is, and I'm predicting what institutions are going to do with it. Big, big money that comes in. And that's how I make money, and that is how you can make money if you want to come trade with me. I like to short because panic comes in selling action, and it creates fear, and then you tend to get big drops. And you tend to get big moves that happen quick. Longs take longer to go. Apple will probably rally right up into the close. You know, would you want to hold that all day? It's up to you. Preferably as a day trader, I think trading in the morning and being done and being up and out is a good thing. You keep your profits in the morning and do whatever you want to do in the afternoon. So I typically look to get in and out in the first 30 minutes of the day of the stocks that I trade, whether long or short. But like I'm saying, I prefer to short. But here's some here you can look at and see. This is a smaller time frame, not the daily, but it's showing you how the move happened very quickly when the stock closed here and gapped down and got sold off right into the morning. You see here, this is right, here's the 9:30, and it's dropping right into the 10:30 period. See where the arrow's going. Same thing over here, and this one here was ASNA. Again, open, drop, fall, collapse. Again, where? Into the first half an hour of the day. In fact, this happened in the first 15 minutes. See it? So I'm predicting that this will fall, so you short it, and that's what you do. Here's another one here. Open, rally, boom, get the move. Right into the first half an hour, first hour of the day. Does it matter where you get out? No. You get out here, 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 here. What about this one here? Again, fell off a planet. Look at the price of the stock. It was a rinker-dink. $4. I will do stuff that's cheap. I'm not doing penny stocks. This has volume, Groupon moves. Look at the move that the stock had. Boom, drop. Okay? Short it, get out. Short it, get out. But you got to know to watch it. You got to know to watch this one here, the Groupon. You got to know to have the pick. This is right on the open, people. Okay? This is where you're getting the flush. Boom, boom. All right? Now let's talk about how much money can you make. Costs involved to trade. What do you need to do this? Like, do you need a college degree, a trade license, or any experience? These are all good questions. The fact is that you do not need a college degree or any license to trade. You don't. If you want to go get licensed, you'll learn more information. You'll have a license. You could go get a job at somewhere at a trading desk if you want to. Work for someone else, trade their funds, trade their money. You could become a stockbroker. But you still should have a strategy that you use to determine the trades that you're taking or why you are taking them, even if you get licensed. All right? If you trade your own funds, you do not need a license. And you don't need a college degree. So you really only need what? A strategy or system that consistently works, a reason you're taking the trade, which for me, it's the reason is the stock is gapping and it rates 20 points or more. That's my reasoning, and my system is called the Golden Gap. You need a computer, you need an internet connection, you need a day trading account or a trading account where you would do options trades. You can contact many, many brokers. There's lots out there. You need to have charts that give you pre- and post-market data. You need a 1-minute chart and a daily chart. Those are the only charts you have to have. You've got to be able to short if you want to do my method, because I'm mostly short. So costs involved to trade are what? If you want to do my class is $5,000. If you want to go to a broker, you have to pay commissions to the broker. And like I said, they vary from $2 to $7. Some are $9.99 a trade. But you can, find places that are cheaper. So you will have to pay a charge to get in and a charge to get out, to take the trade. You also will pay platform fees when you go and open up an account. They could range from free platforms. Some brokerage dealers have free platforms. Some platforms can go up to $450 a month. It depends how, what kind of platform you want to get. And then how much money can you make? The amount of money that you make depends on the amount of size that you take in the trade. That's what it depends on, and it depends on your level of consistency. The consistent number of wins that you get versus your losses. You must have more wins than losses, or you will not make money trading. That's the bottom line. You can have one huge day, one huge big win. You can have one huge monster week. But if the rest of your weeks are losing weeks of all the years that you trade, you will be down. So you have to have a system and a strategy that is consistently profitable. It's the only way that you're going to make it. So talking about share size here, just breaking it down again, and then I'll take any questions because I'm almost done. If you have 1,000 shares and the stock moves 50 cents, how much would you make? $500. If you have a move, the stock moves 50 cents, you have 2,500 shares, how much will you make? $1,250. If the stock moves 50 cents, you have 5,000 shares, you make $2,500. Can you live in $2,500 a week in one trade? A day? The answer is yes. Anyone could. I mean, that's good money. Even $500 a day is good money because it amounts to about $2,500 a week, and that is good money trading. Many day traders are not making that. That's 10 grand a month. That's more than 6 figures a year. That's enough money to do it for a living. But you got to be consistent and you got to get the right picks. And when you lose and you have a trade that doesn't work, and the one yesterday did not work, you can't do 5 other stock symbols. You can't say, oh, this one didn't work. I'm going to do this one and this one and this one and this one and this one. That's how people blow up. If one day something doesn't work, whether you take one trade or 2 trades in it, it shouldn't kill you. But you can't trade from 9:30 to 4 o'clock looking to get back one loss that happens in the morning. And this is where many people don't understand and they falter, all right? You've got to understand that tomorrow you'll get up and you'll get it. You'll get up and you'll get it tomorrow. You'll get up and get it the next day. If you believe in your system, you trust in your system, you have conviction in what you do, which I do. I do because I created the system myself, and I also do because I've been trading for 8 years, then you will know that in your mind and feel okay about it. Accept the one loss that you have and get up the next day and go in and make money and just do it. Any questions at all as I'm talking here? So, my class is called the Golden Gap System. It's a professional bearish gap rating system. The purpose of this system is to help you evaluate which gap to trade each morning using a checklist, and that is how I do it. This checklist tells you what to trade and when. It measures gaps by rating them in the daily chart to find stocks to trade that have, number 1, a high probability of direction of bias for the entire day. Number 2, a big move on the day. Number 3, early confirmation of the bias and move between 9:30 and 10 a.m. And number 4, precise entries with follow-through and a good risk-to-reward target potential. That doesn't mean you're holding every trade to the target, but many of them do go to the target. The time of the day varies, though. Sometimes I get out of a trade because I want to get out by 10, 10, 15, 9:45 even, and I have things to do the rest of the day. But the stock could keep dropping, which some of them have, like the one today in the PBI. It kept dropping all day. You could have been in all day. That's not what I like to do, but there's different cases where things just keep going, and that was one of them. But my system teaches you how to trade, and more than that, it actually teaches you how to make money. Okay, it's based on the points. And you learn in the class the 26 points. You learn how to enter the stock, how to exit it. You learn how to look at technical analysis, read charts and gaps. You learn how to look at what is really happening. Is an institution buying this and why? Is an institution selling this and how am I seeing that? It's a window into my brain and into my mind, and that's what you learn in the class. And it is a system that you would do and follow. And listen to what I say if you're in the trading room too, and take the calls and take the trades and do it. Okay? I do not enter the pre-market. Yes, that's correct. I wait until the open. So if you're interested, my class is next weekend, February 11th and 12th, from 9 a.m. to 5 p.m. Eastern Time. It's online. You can be anywhere in the world and take it. And actually, half my clients are international. They don't even live in the U.S. So it doesn't matter where you live. You can trade the market. The time zone, though, that I live in and trade in is Eastern Time Zone, and it is the time zone of the market. Okay? So the cost of the class is $49.99. Retakes are free. Once you sign up one time, you can take it as many times as you want for free. And it is taught online. And it's live. And it's full on. 9 to 5, okay? And you will pay attention, and you will learn many, many things. So I'm doing a webinar special. If you want to sign up by this Saturday, I'm giving the trading room free through June 30th, 2017. That is amazing. That means you could be in the room and take every trade that I call and do Monday, Tuesday, Wednesday, Thursday, Friday between now and the end of June. That gives you plenty of time to learn, and then you'll know if you want to stay in the room after that. If you want to stay in the room after that, great. If not, you learn everything in the class to do it on your own. It's up to you. I try to encourage people to do their best. I try to mentor them. I try to talk to them. I answer your questions. You get me in the room live every day, okay? The class sign-up forms are not on my website. You must email me for the forms if you want to sign up. And the deadline is Saturday, no exceptions. But you'd be signed up ahead of time. You could be in the room, and you could start the room next week if you want to be in the room. One guy today, he calls himself Roomy in the Room, which is a funny, funny name. But he already signed up for the class for February, and he made almost $2,000 today. Or was a little over $2,000. I think he did that PBI twice. He got in and got out and he got back in again. So he paid for almost half the class just being in the one day this week. I don't know if he's done anything else this week or not, but he told me he did that today. But he did it twice. So, I mean, it's up to you. You could be in the room, though, next week. I suggest, though, you be careful until you do the class, but if you already have a trading account, you could do it. And I actually just gave you a free trade here today in the Apple option. You could do it. I mean, the Apple option is out till the end of next week. You're going to pay up now for it versus this morning if you've gotten it, but it's going to go over 130. The best price was to get it into the open today, but I just gave you a trade today if you want to do it. You got an hour and 15 minutes to take it, All right, let's see the questions. What account size do you suggest to start with minimum? If you want to go to a proprietary day trading firm, you can open up an account with as little as $2,500, but I would suggest $5,000 to start. You get 10-to-1 buying power, which would be a $50,000 buying power account, which is good enough to take the day trades and make money. Depending where you go, you have to ask them if they will do options or not. If you want to go to a retail place, like somebody mentioned Ameritrade, you would need how much? To do a day trading, you would need at least $25,000, but you actually need more than that at a retail account, because if you go and under 1 penny under $25,000, you will get a call, a day trading call, and then you will have to put in the 1 penny. So you actually need more than $25,000 at a retail firm, and your leverage is 4-to-1. So you would have $100,000 in buying power if you had $25,000 in a retail account, which again is more than enough to trade my system. I don't tend to take extremely expensive stocks as a day trades. If I take something that's $65, that's on the higher range for me to do in a day trade. I'm not saying that I don't do stuff that's over $100 price point. Sometimes I do. Sometimes I definitely do if it's a good gap, but I do tend to stay in the range of price points between $5 and $60, $65. It's not that I'll never do anything over 100, but I am doing option trades that might be expensive stocks, but that has nothing to do with the price point. You don't need to worry about buying power. So there's 2 options. If you want referrals for brokers, you can email me, but there's a bazillion places. But you only have to make sure that you can short. So the buying power is what you need to be concerned about to take the positions, and then you will have a stop loss on the day, which will be dependent on the amount of cash that you have in the stock in your account. If you have a $5,000 proprietary day trading account, you cannot risk $1,000 in your trades. That would be ridiculous. You can't risk 20% of your account in one trade. So if you have a $5,000 proprietary day trading account with a $50,000 in buying power, I would risk $250 in a trade. Okay? And with that, what if you made $500 a day? You should be able to turn it around at least once or twice, a couple of times a week. That's good. You could build it up. You could build up a $5,000 account to a $10,000 account. You could open up a $2,500 account. Don't take any money out. Trade, build it up. Build it up as long as it takes. Okay? Build it. Not everybody can start out exactly where they want to be, which is what? At the top. Nobody starts at the top. Nobody does. Nobody in the world. Get realistic. If you start to get realistic with what you can achieve, guess what? You're going to start to get somewhere with yourself in your life and your trading. Many, many people are not realistic. I, in general, am not really that realistic, except for the fact that I'm very goal-oriented. So I am realistic in the sense that I am a high achiever. But so it seems that I'm not realistic, if you know me, because I have such extremely high goals for myself, but I always achieve them. But I'm realistic in the fact that it may take work to get there, and therefore it may take time. So over the years, I've become more patient with myself to achieve my goals, knowing that it will take me time. I'm still completely not realistic compared to the normal person for my goals, but I always seem to achieve the goals I set out for myself because I'm willing to work hard to do it, and I'm willing to understand that it takes time. But what I've found that people are not realistic is that the time of the money that they want to make and the time that they want to do it for where they're at with their life and the money that they have. So what I'm saying to you is have great big goals, but go easy on yourself where you're at right now so that you can get off the ground to start achieving them. Wait until you have $25,000 in cash to open up a retail account and can quit your job and trade full time and have $100 grand in the bank to go and not work for a year till you learn it is probably not realistic. So what can you do? Well, you can have this amazing goal that you're going to make money in the market. That's realistic. But what's your path to get there? Your path to get there may not be this extreme thing where you're going to have all this money in the world, you're going to have all this time off to study and focus and do it, and da-da-da-da-da. No, okay? And where you're going to risk $1,000 of a $2,500 account. No. You have to say, here I am right now at this point. This is what my goal is. Okay. It's good to say to yourself, well, I would like to achieve this goal within 12 months or 3 months or 6 months or 2 years. But you may not. You may achieve it before you think, or it may take you longer. But you still need to have a plan of action to get there. And as long as you're on the path to do that, you'll be fine. What happens is having no plan of action or a totally unrealistic plan of action, which is to roll out of bed in the morning, quit your job, and have no money in the bank and have a $2,500 account. I mean, you have to be, thoughtful about what you're doing. Don't quit your job or risk too much money trading. Don't risk the farm if you don't know what to do, okay? And you absolutely should not be trading any money at all in the market if you don't have a strategy. I'm just telling you right now, don't do it. And there are people that do it. I talk to people that tell me they have no money and they have a retail account with $25,000 in there and they tell me they can't afford the class. And they have no strategy. They have nothing to do. And they trade every day. They trade every day and they lose and they refund it. They trade every day and they lose $200, $300. They keep refunding it. And they have a job and they keep refunding it, but they're getting nowhere. And 5 years from now, that $25,000 account, they will have refunded $25,000 over and probably $50,000 over and still be working their job and not know what to do and losing money in the market because they don't have a strategy. You've got to have goals that you can achieve and a plan of action to get there, and you got to be a little bit realistic with yourself, but you can have high goals and you can be a high achiever like me, but you have to be realistic about how you're going to get there and the time frame to do it. Trust me, I've learned the hard way. Most of the money that I lost actually was at the very, very beginning of my trading career. In the first 3 months, I lost most of the money that I lost before I figured all this stuff out. If I could go back in time and rewind and go back to 2008, I would never have risked the money that I risked when I started out. But I couldn't. I can't go back. It's too late, and I can't go back, and neither can you. So we can only go forward. And that's all that we can do, and that's all that we will do, okay? So figure it out, get a plan of action, get your head on straight, okay? Think about the things I said tonight. Good group for this afternoon. I don't even know what time it is. It's dark here in New York. It looks like it's going to snow again. Does anyone have any questions? My email is melissa@thestockswoosh.com. Thank you, Investing, for having me. You're amazing as always. Very, very nice people here at this company. Good people, decent people, honest people. And these things matter in this world, let me tell you that. All right, have a good day, everyone. You're welcome.